Today's guest discovered a new way to enjoy dividends, FIWOOT. Let's see what this beast is made of.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour, Vero here, and you're listening to the Dividend Guy blog podcast. Today, we welcome Mark from My Own Advisor to the show. Mark has been investing since his 20s and is about to reach semi-retirement after exploring the joys of FIWOOT, financial independence, work on your own term. For this episode, he will share his best tips on paying yourself first and welcoming more flexibility. Thanks for accepting the invite. I'm so glad to have you here. How are you doing?
I'm happy to be here, Vero, and thanks for having me. It's been a while since I've been on the Dividend Guy blog podcast, so it's nice to be back.
Yeah, I'm so happy that you accepted the invite. I mean, I believe you're like my third guest ever, so thanks a lot.
Oh, that's awesome.
And I feel comfortable with you because I have a revelation to make here. Today is our first time meeting, but I've known you since 2010 when I started working with Mike. You were already writing on My Own Advisor back then. And let's be honest, not so many blogs have survived since. So how does it feel to be around still?
Well, I feel older. So one thing, I think I started the site. I really ramped it up in like 2009. And then you're right. You started probably working with Mike 2010, 2011, around there. You know what? Honestly, Vero, it's a bit of labor of love, right? Like you could probably appreciate working with the DSR stuff and doing the newsletters and the stock cards and things that Mike does, right? He's very passionate about things. I think obviously you're still doing this like 10 years later, right, with him as a bit of a passion project as well. So I think ultimately for anything to have that much longevity, you have to be passionate about things and you have to have a little bit of fun too. So I still have fun with my site. I still have fun with my readers. Hopefully they learn something from me and I can learn something from them. And as long as it's fun and I have some passion, I'll keep doing it. So.
And I think you bring up a very good point because people may think that it's easy to build something online, but it's really not to make it last. So congratulations on that. And of course, passion and fun, like you said, are really keys to stay there and make sure it works.
For sure.
So that said, your saving and investing journey started way before that. Actually, your first trigger was the book, The Wealthy Barber, and it's like a common title around, right? So what does this reading change for you?
Yeah, I think ultimately what happened when I read The Wealthy Barber, it's kind of like the Gen X book of, personal finance, right? For my cohort and stuff like that. So when I read The Wealthy Barber, I think the biggest takeaway is ultimately paying yourself first, right? And then you keep paying yourself first till you retire or semi-retire, or for me, it's a bit of a financial independence, work on own terms kind of thing. So I think that was the biggest takeaway, and it was probably the biggest takeaway, honestly, for most Gen Xers who read the book. And ultimately, I think through paying yourself first, what you do is we'll probably talk about this a little bit, is you just end up creating that buffer between the money you make and the money for your future self. So whether it's $25 a month or whether it's 100 or whatever you can squirrel away, ultimately you're basically helping your future self. And I think that's a big takeaway, regardless of what age you're at, 20, 25, 30, paying yourself first is probably a good principle.
And at what age did you read that book again?
Gosh, when did it come out? Late 90s? Late 90s, late 80s. So I would have been 16, 17 or something. So
So you started your work life on a strong note with that in mind.
I think so. But, I was also working when I was really young. Like I remember, I don't know, some of your audience may remember papers. So I had a paper route when I was younger, right? So that was kind of fun. And I was doing that when I was like 12 years old. So I've been working for a long time. So I'm not sure if I'll do a paper route in my semi-retirement, but it was one of those principles I kind of thought, okay, that would be good to pay myself first and keep a little bit of money for me and I can spend the rest.
And, I went through your website and I saw many references to paying yourself first. So why is it so important to you? And what are your best tips for achieving that?
Yeah, great question. So I think where I come from, my perspective on this is paying yourself first. Like I mentioned, it's really putting away money for your future self. You don't know what the future is going to hold. You don't know if you want to take a big trip. You don't know if you want to be able to retire early. Maybe for those that have kids, you may want to help your kids with their car payment or a down payment on a home. So to me, it's incentive to kind of just have a little bit of money for your future self. And I think some
Mm-hmm.
of my biggest tips, to be honest, are like, I think for one, consider yourself like a company, like a bill payment. So,
Mm.
Vero Inc. or Mark Inc., right? You're paying yourself first like you would with your cell phone bill or your internet bill or anything else you use. So consider yourself like a company that you need to pay. I think that
Right.
would be a first principle. And then where you can automate it, right? So a lot of us put maybe our bill payments on our credit cards, or they have pre-authorized debits coming out of our bank account. And that would be the second big tip I would say is once you automate some of your savings, hopefully for investing purposes, it's money you never see and it's money you don't
Mm-hmm.
spend and it's money that can grow, right? So
Right.
I think, changing maybe your mindset around who you are in terms of a company that you want to invest in and how you invest in that company as you put away some automated savings. I think those are really two really good tips for a lot of people.
That took me such a while to figure out, honestly. I have a project for 2025 and I want to buy a horse. My daughter
Mm,
rides horses too. And like, this is probably one of the biggest expense you can have in a life, but it's a lifetime dream.
yeah.
So I thought there should be a way for me to do that. And I pretty much did what you're just saying. I started to say, okay, so I need to think about my project like it's a company, like it's something I really need to pay for. And
Hmm.
I decided to work more hours, and with that extra income, I really like automate savings, and it works. I mean, I'm not done yet, but it adds up very quickly, and I don't necessarily see it, and I don't feel like you've said I'm not gonna spend it because I mean it's kind of hidden somewhere. So
Yeah. Well,
so it does work.
I mentioned this at maybe a TD Direct Investing webinar when they were asking me to come on and talk to them about my journey and stuff. But it's somewhat similar, like, trying to eat healthier. Like if you buy the potato chips like I do and you keep them in the top cupboard and you can grab them, right? It kind of messes with your diet a little bit. And
Hmm.
potato chips once in a while are great, but if you're really trying to change behavior, you need to kind of not see the potato chips in the cupboard. So if you
Right.
can automate some of your savings for investing and you don't see the money, then you can allocate that money for something else. So anyway,
So you started putting money aside and then you opened a brokerage account with just
yeah,
$25.
I
Do
know.
you remember what you bought with
Yeah,
that $25?
I did. I believe I bought a equity fund from one of the big brokerages, right? One of the big five banks back then. And
Hmm.
you didn't need a lot of money. They basically said, hey, you're a young guy in your late teens, early 20s or whatever. And I opened up my brokerage, right? And I've had that, similar brokerages kind of ever since, right? So obviously
Hmm.
in my early years, I was too young and the TFSA didn't exist. So I had the RSP or a non-registered account, and that's basically what I had. So yeah, you look back and you think, wow, that $25 went a long way to creating
Sure.
some good habits. So that was pretty cool.
So you probably added up to that for a while, but when did your investment profile and asset allocation started to change and why?
Yeah, good question. So, and I've gotten this from my readers as well over the last like 15 years of reading my site and listening to me on
Hmm.
podcasts and webinars. And I would say I'd break my life cycle down into a few like blocks of years. So in the early years, like the 90s, late 90s, I was investing in a few tech stocks beyond the equity fund that I had. And we all know what happened maybe to tech stocks back in the 1990s or late
Hmm.
90s, right? There was a
Right.
big boom, big bust. So then I'm like, okay, maybe I need some bonds. So maybe my next phase was I would keep some of the equities, but I would invest in some bonds, right? And bond
Hmm.
ETFs were just becoming more popular, but I had low cost bond funds to mix with my equity ETFs. And I went through, some of that stuff until probably the great financial crisis, right? And that was like the
Right.
2008, 2009. But some of the equity stuff I was investing in back in the time, I was like, wow, I didn't realize it went down that much. And why did it go down so much? And, 15 years ago, I'm like, I thought my fund was supposed to be more conservative and not aggressive. And why did I lose all this money? So after I started some digging, that's kind of the dawn of my own advisor. I started to ask, where are all these fund fees going to? And why am I paying
Hmm.
such high fees for bad performance? And so I started doing my own research and reading and such. And then really since I would say from 2008, 2009, really the dawn of my own advisor website, I've been investing in mostly dividend paying stocks. I've had a few iterations where I bought some dividend ETFs here and there, but I've slowly gravitated to basically what I've landed on in the last 10 years or so is my hybrid strategy, right? And I think Mike and you are of similar mindsets in that it's okay to invest in some dividend paying stocks, but you also want the total return. You want the growth component too. So basically for the last 10 years, I've got a mix of Canadian and US dividend paying stocks, and I've got a couple low cost ETFs that have really done well for growth. And so that's kind of my hybrid strategy. And that's kind of where I am today and where I see myself going in the next few years too.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. I'd like to dive in more into that a bit because, it's different from what I'm used to doing. So your hybrid strategy approach, what do you feel it brings to you that dividend growth stocks only wouldn't, or that ETFs only wouldn't?
Yeah, I think where I come from on the hybrid approach for me is, there's some content on Mike's site related to this and maybe some of his newsletters as well, is that dividend stocks unto themselves provide, maybe some income or hopefully some growing income, but they don't necessarily really catapult you into great growth, right? So I'll give you a couple examples, right? And I know Mike's owned some of these stocks and been in and out of them and has new stocks on his website too. But like if we think about Disney, right? So Disney was a great stock until it wasn't. And then they cut their dividend, right? And then, CAE, I remember Mike had that on his website before and he had it and it grew, but then it hasn't really gone anywhere, right? And I think he's long since changed that too. But, when we look at the equity side of things, or maybe the total return component, right, in terms of a low cost global ETF, you don't really have to worry about your dividend. You're not focused on your dividend growth because that's not why you buy that fund. You buy it for total return, like long-term price gains. So in my thinking, the dividend investing approach that I have, it provides kind of some of the stable income, if you will, like a bit of a bond proxy, if you will. And yes, I'll may get the odd dividend increases from some of the companies that Mike writes about and I write about on my site. We own some of them together. But if you're totally focused on dividend stocks, you're kind of missing a whole universe of other stocks that could grow, right? Stocks that don't pay any dividends, stocks that are potentially from the US and offer high price appreciation, right? Some of the tech stocks. So you're actually ignoring that whole world. And I don't know if that makes a lot of sense. So to me, I like the balance. I like the blend of dividend income and growing income from my portfolio. But I don't want to ignore the fact that US market has gone up like 20% last year and up to 25% this year. There's not many dividend stocks that have been doing that. So in a nutshell, I feel I get the best of both worlds with the hybrid strategy that I have.
So basically the ETFs that you hold, most of them are not paying dividends, right?
Yeah, they'll pay distributions, right? So there'll be like an ETF distribution, like maybe a 2% yield. Exactly. But to your point, I'm not investing in a low cost ETF for the yield. I'm investing in a low cost ETF for more global long-term growth. And I intend to hold some of these ETFs, which I have, some of them for 5, 6, 7 years. I hope to hold them for many, many more years, just because by design, they don't own just dividend stocks. They own like literally thousands of stocks from around the world.
But I mean, the question I have here is, of course, we can all make mistakes when selecting like individual stocks, but ETFs will also include some of them. Like they're not just completed with amazing growth stocks. I mean, they have like you've said, thousands of stocks in one ETF. So to compare an investment strategy, we must consider like an entire portfolio, not just a few stocks. I mean, it would not be fair for me also to pull out all of Mike's top performers and say that he has beaten the index over the past 7 years, for example. So
Yeah.
bad and good stocks are part of any portfolio. The same applies to ETFs also. So wouldn't it be better to compare the total return for both of your complete portfolios, for example, over a long period of time to really have a clear vision of the total return and results you're talking about?
Yeah, that's a good point. So what I tend to do when I think about like portfolio performance and that kind of stuff is I'm not shy in terms of sharing some of the stocks I own. It's published on my website, and
Right.
your audience can look at that as you have, right, under my dividends link or under my ETFs link. I do tend to benchmark my Canadian portfolio against a fairly reputable index. And
Right.
to be honest, Vero, I want to make sure that I'm not underperforming that index, because that means the stocks that I do pick, I'm probably not very good at it, and I should just be buying the Canadian index. And then the same is true for the US side, right? Is you kind of want to make sure if you're going to pick stocks, generally speaking, you're being, close to the index that you're picking the stocks against. Otherwise, why bother, right? And so it's a good point that you do need to think about your collection of stocks, or, even if you just own ETFs, the sum of all those things as an entire portfolio, and making sure that you're generally benchmarking yourself where it makes sense. And that being said, benchmarking, as you know, with Mike and such, it's a point in time, right? Sometimes you'll underperform and sometimes you'll overperform. But generally speaking, you want to see those long-term trends towards your goals.
I think that we could argue about strategies, but in the end, what really matters is the fact that you invest consistently. Like what all successful investors have in common is they stick to a strategy for a long period of time and they invest consistently. So, I mean, as long as you're comfortable with what you're doing, and like you said, if you can compare to a benchmark once in a while, then it gives you an idea if you're a good or very bad investor. But I don't think you are.
Yes. I like your point about basically just finding a strategy that you can stick to, right? And some folks are all dividend stocks. Some folks are all ETFs. Some people are hybrid, like me. Some people are total US and ignore Canada. And other people have gone all in on Canada and have.
Sure.
And ultimately, I think as long as you're meeting your goals and you're managing your risk, then there's lots of ways to get to Rome, per se, right?
I mean, even people investing in mutual funds with a financial advisor can retire comfortably if they do it consistently. So
totally.
But yeah, so I want to go back to your portfolio. What's the balance between equities and ETFs?
Yeah, I would say individual stocks, I'm probably like 75-ish right now. And I'm probably about 25 on the ETFs. And I think that's going to change a little bit in the new year, like 2025, just because there's some changes with like pension plans and things like that at the workplace. So that's probably going to shift a little bit, maybe more in favor of the ETF path. And then I'm also building some cash equivalents for spending, right? I don't really want to touch my portfolio too much, Vero. So I'm kind of creating a bit of a cash wedge in 2025 as well. So yeah, but that's the general mix right now, is maybe a 75-25 mix, and so far so good.
And since you use a mix of ETFs and dividend paying stocks, what makes an individual stock worthy? Because the way I see it is like a VIP position in your portfolio. So what makes a stock worthy of that?
Yeah, I mean, I like things that are moaty, right? So like moat-like stocks, so that they have a competitive advantage and such. And I think Mike and yourself have talked about that on various podcasts in the past.
Yes.
And I also like, again, maybe it's part of most metrics for DIY stock investors, but you want to see earnings grow, right? You really want to see a nice upward trend of earnings. That's important. I also like modest payout ratios. Like you don't want to see a payout ratio, like gosh forbid, some of the telcos are getting too high, right? So that's a bit of a warning sign, right? So you want a modest payout ratio. I think you want to see high cash flow. So after kind of all the debt payments and things go out the door, you want, higher cash flow over time. And then dividend growth too, right? You want to see meaningful dividend growth, like getting 1% raises every year. Maybe you should be just more than an index fund, right? Like some companies have been doing recent years, 5%, 6%, 10% kind of dividend growth rates. That's really good too. So those are all kind of the measures and metrics I kind of think about. Those tend to be the ones that have a longer term home in my portfolio than others.
So you don't focus on yield whatsoever, right?
No, I have a couple high yield stocks, but I don't search for yield. It's not like my primary go-to, right? Like, it has to pay this amount of money. I don't really worry about that. 15, 20 years ago, I was like, oh yeah, I want to make a lot of money and this is the way to do it. But you realize as you get older and mature an investor that again, dividends are good and dividend growth is good, but you also need the growth side too. So it's two sides of the
Right.
same coin, I say, right? Dividends and growth.
Of course. So, Mark, we exchanged notes to prepare for the episode, and one of my questions in my first questionnaire was about your favorite stocks, and you answered it's hard to choose a favorite child. And I believe this is what we should all have in mind when selecting stocks. Like if you don't see it like as a friend, then maybe it's not one you should buy, right?
Yeah, it kind of gets back to some of my criteria that I talked about, but you're looking for companies that have a competitive advantage and you're looking for companies that have kind of a higher dividend growth rate than others, modest yield, higher earnings per share. So those are kind of the factors. But yeah, I mean, if things don't fit your investing thesis, and I think you and Mike have talked about this before, and your investing thesis may change over time, just like the companies may change over time. It's okay to kick it to the curb, right? It's okay to say, don't keep it. My thinking has changed. The company's management team, the board has changed their direction, and that's okay. And I think that's where, you want all your kids as they grow up, I guess, if you have kids to be successful. But at the end of the day, they're still your kids and you got to keep an eye on them, right? So just because the kids grow up into be adults doesn't mean you can and you don't want to leave them in the wild. So I think the same analogy a little bit goes to stocks, and that you do need some monitoring and you do need some maintenance. So yeah.
Yes. And maybe you need a little less with ETFs, right?
A little less. Yeah, exactly.
And have you ever checked if your equities positions are duplicated in your ETFs? Like, would you consider that a problem, or do you not mind at all?
I used to have that problem when I was younger. So I'll give you an example. So I invested in a US dividend ETF, a fairly popular one, right? It's one of Vanguard's products. It held a lot of US stocks, but then I also held some of those stocks that I thought would do better in my RSP in particular. And so I kind of had that, diversification, if you will, right? I was doubling up. And so what I've done over the years is I've reduced my number of US stocks. And over the last, 5 to 10 years, I've owned more low cost ETFs to take advantage of the US market. And I've done really well. And I haven't had the doubling up problem. I have, I think right now, maybe I'm down to a handful of US stocks. And I'll keep maybe a couple of them for certain reasons, but I could see a time in the next 5 or 10 years really to simplify my portfolio. I'll just keep the ETF and let it go. And the ETF I own, it's ex-Canada. So the benefit of that is I own a global basket of stocks kind of with the US and the rest of the world. But then if I still want to own the Canadian stocks, I can keep them and I don't have the doubling up issue. So I'm getting to that point now. I probably will still own Canadian banks and, pipeline companies and other kind of lower yielding, higher growth stocks in Canada. That's the way my portfolio is set up. But I won't be doubling up on a Canadian ETF on top of all the Canadian banks or pipelines or utility stocks. So
yes.
I think it's a good question to ask because you don't want to duplicate or triplicate your portfolio. It doesn't make a lot of sense. And I think a lot of DIY investors, they get gravitated to the shiny stock or the shiny ETF and they end up doubling up on things. And you need to unbundle that.
Sure. I'm glad that you bring that point because we've been telling investors for a while, those who do both, we just say it's all good. You can do that for sure. But I mean, just make sure that you don't duplicate your exposure to 2 or 3 companies, because you have them in 3 different ETFs and then you also hold them individually. So anyway, so you've said you hold both Canadian and US stocks. Are they equally weighted or do you have any preference? I hear you talk more about Canadian stocks. Am I wrong?
You are correct. Yeah, you've been reading my site quite a bit. So I do have probably a bit of a bias to the Canadian stocks in my portfolio versus the US stocks for sure. And just for the reasons like I mentioned, I own some low cost ETFs that play the US market. I own a tech ETF that owns all the Apples and Microsofts and Nvidias of the world. So I don't have to do any stock selection. I can just put my money in there and let it ride. But I do have a bias into choosing my own Canadian stocks. And I think you probably read this on my site as well, but I've basically taken a top Canadian ETF, like XIU, for example, that owns the top 60 stocks in Canada. And I've unbundled it, right? So I've basically said, you know what? I don't want to own that company because of these risks or these perceived risks for me, but I'll own, the banks or the pipelines or the utility companies and some other kind of companies that I have a lot of confidence and conviction in. So I do write a lot about the Canadian stocks, and I probably own, as a bias, definitely more Canadian stocks than US stocks. But that's just because I do find the Canadian market a bit easier to unbundle, right? It's easier to kind of know what top companies are because you can see them in the ETFs, right? And we all know the names. We drive around our neighborhood and we know the companies that generally are making money because they're on the corner, right? Or we go shop there or whatever. Yeah.
And I mean, the Canadian market is not like as diversified as the US ones do. So like you said,
Correct.
it's easier to identify the good ones.
Yeah, exactly. Like Canadian financials are what, 30% of our Canadian market. Energy is about what, 25%. And most of us can count those names on, on our fingertips a little bit. So, and to your point, Canadian market's only what, 3% of the global market. So you just have to be careful about kind of the geographical stuff too.
And you mentioned that you use XYU as a benchmark for your Canadian stocks. Why did you choose this one?
Yeah, I used XIU basically for the reasons that I tend to own a lot of the same companies in the top 20 to 30, right? So that becomes a really good benchmark, I think, for me, generally speaking. And to be honest, until I'm proven wrong, maybe, like unless those top 20 or 30 companies stop making money, then those are probably the companies from a market cap perspective to own, right? So there's going to be exceptions, right? Middle companies or smaller companies are going to grow and become bigger companies over time. But I actually went back on my website like 15 years ago, Vero, and I looked at like what the top companies are in Canada, like back in 2011, and they're not that much different in 2024. So there's a few exceptions, but generally speaking, we've talked about it already. Our market is fairly concentrated and it's fairly small. Yes. And so it doesn't mean the smaller players won't grow, but generally speaking, that constitution, the biggest companies in Canada haven't changed that much in like 20 or 30 years, really.
Which is not the case in the US, I believe.
No,
I mean, I did not look for that information, but I mean, things evolve so much faster on the US side.
Yeah,
right?
like I think if you look on my website, I had an article about this. I'd have to bring it up and maybe I'll share it with you and Mike after. But 20, 30 years ago, the biggest companies in the US were like Johnson & Johnson and GE and Procter & Gamble, right? There wasn't a big Microsoft at the top. There wasn't, NVIDIA. There wasn't Amazon. So it's really changed. In Canada, not so much, but in the US and around the world, big changes. And that's the growth story that we just talked about, right? I couldn't predict Amazon would be as big. Otherwise, I would have bought it years ago.
Of course.
Yeah, of course. Right.
It's easy to say once it's done, right?
Exactly. But in Canada, we're pretty stable and we know where the income and generally speaking, where some of the earnings come from some of the companies. So. Yeah.
Okay, so I feel like we could go on and on about investing, but I really want to discuss your FIWOOT lifestyle. How would you describe it?
Yeah, so you mentioned it off the top, and it's actually what it sounds like it says. It's financial independence and work on own terms. And, working on own terms is basically a way of saying, hey, we've hopefully reached a level of financial independence where we still want to work, but it's a little bit more on what we want to do and when we want to do it. And so for me, ideally, Vero, what I want to do is, I'd like to stay with and contribute to my current employer, but maybe just do it in a less capacity. So maybe it's not 5 days a week, and maybe it's not, X number of hours here and there on the weekends once in a while, but it's a little bit more scaled back and it's a little bit more aligned about, I mentioned this before, it's a little bit more like a life work balance, not a work life balance, right? So we kind of flip it around and we kind of say, hey, we still want to work, we still want to contribute, but maybe we just want to do it at a less capacity. And so when I think about FIWOOT, it's very similar. It's basically my semi-retirement plan. I'm still going to work hopefully in 2025 and in 2026 and in 2027 and who knows, and we'll do more podcasts together. So I still want to work, but I don't necessarily want to do it all the time, every time. And I can hopefully, as I get older, pick and choose a little bit about how much I want to work and what I want to work at. So that's the plan. Hopefully it'll all work out for me and my wife in 2025. It's fun to think about, right? It's exciting to think about the next phase, because I really feel like you don't retire necessarily away from something, you retire to something, right? It's just the next phase. And so I'm kind of looking forward to this next phase.
I like that idea. I really like that perspective you just brought. I love it. But why do you think this came to your mind? Like, was it something you were thinking about like in the last decades, or like, probably not that, because with what you just said, I don't think it's that, but like, did you become sick of working? What was the source of that?
Yeah, I was thinking about the FIRE moniker, right? Honestly, I was thinking about financial independence, retire early. And like, Mike, you, other people that have passion projects like this, like what we're actually talking about tonight, like even if you wanted to retire, you probably wouldn't really retire. You know what I mean? Like
Right.
we're all too young, and hopefully we're all, have our health for many years to come. So the whole financial independence, retire early, or the FIRE movement, that's interesting.
Mm-hmm.
I've always gravitated to the FI part, the financial independence. I didn't really get the RE part, because everybody that I saw, whether they run a blog or a podcast or write a book, they're not retired. They just retired to something else. They're just doing something
Right.
else. So I didn't like the RE part of FIRE. Now you could argue that, well, yeah, that's the whole point. You retire early so you can do whatever you want. But I didn't like the connotation that you're retired, you're actually doing nothing. And that's not true. No 30 or 40 or even 50 something, early 50 something truly retires and sits on a beach and reads a book and, goes through their phone. So I was thinking years ago, what does FIRE really mean to me? And to me, it means financial independence for sure. But it's
Yes.
also the ability to work as much as I want, at what I want, and when I want. So working on own terms was kind of my way of saying, I want to work and I want to contribute and I want to stay mentally active and do fun things like this. But at the same time, I want to be able to pick and choose when I want to do it. So hopefully the next time, maybe a year or two, I can speak to you from a villa in Portugal and I can tell you that I'm working on my own terms. So that's FIWOOT.
That would be great.
Yeah.
And I mean, like you said, all the people I know who really retired and did pretty much nothing, they died young because they were bored. And I mean, it's sad. I
Sure.
laugh, but it's not funny at all. I mean, this should not happen. I think that even when you retire from work, so to speak, you need something to get yourself busy and to stay healthy, right? So
Totally.
it makes total sense to me.
Yeah,
Like
and
you
there's
said, financial independence is great, but you need a sense of purpose at one point.
yeah, we're all wired that way, right? We all want a reason to get up and get motivated every day, and everybody's work on own terms. Their woot and the FIWOOT could be different, and that's okay. Ultimately, that's what the financial independence does, is it gives you a little bit more of the life work balance instead of maybe the work life balance. So yeah.
And when do you consider you reach FIWOOT? And also, like, what concrete examples of flexibility do you have that FIWOOT gave you?
Yeah, so I think as of next year we're there, right? Like, so that's the plan at least, and happy to keep working, again, hopefully in a part-time capacity and all that good stuff. I think my thinking is I'll still work a couple days per week for sure, like, put in full-time hours a couple days a week. So I don't know if that's like a Monday, Tuesday, Wednesday, or maybe, something in the middle of the week. But the thinking, Vero, would be to have some long weekends almost every week. I love golf, so maybe I'll work at a golf course for a day a week, right? And have a day to maybe work in the morning and then play golf in the afternoon. Who knows? So if that happens next year, the year after, that's cool. Pick away at the blog and run my own advisor, or with my partner Joe at Cash Flows and Portfolios, I can help people with their retirement income reports and things like that. I could do podcasts like this. I can work with the TD Direct Investing folks and do some fun things with them. And then honestly be outside, right? Like the whole FIWOOT and life work balance, be on the mountain bike more, travel a bit more, and do other things. So, and hopefully I can work from anywhere eventually, right? I can have a laptop. I can move this thing around and move anywhere around Canada or around the world, right? So
Right.
That's I think what the financial independence offers, is the optionality and the functionality of time, right? Is you can move around and be as flexible with your time as you want. So hopefully next year is the start, and then we just keep building from there.
And maybe this episode is kind of a eye-opening story for some listeners who would be attracted to the lifestyle you're talking about. So what type of people do you think are made for FIWOOT, and how can they achieve it?
I think first of all, you have to have a passion for being self-directed, right? And what I mean by that is you need to be a bit of a self-starter. You need to have your own internal motivation, whatever that motivation is. It doesn't have to be all about personal finance and investing. You mentioned earlier, you could have a very trusted, partner and a financial advisor and so on, and work with them to achieve your goals. And I think that's great. But that initiative has to come from you, that motivation around saving and investing and understanding where your money goes and where your time goes. All that's got to come from you. So I think the first ingredient for anybody that wants to pursue FIWOOT or semi-retirement sooner than most is you have to have the motivation and desire. The second ingredient you need to have to help you with that is the financial literacy, right? So even if you have a financial advisor, even if you have a planning friend, or the work we do at Cash Flows, or the coaching I do over the here and there with my own advisor, you have to have some level of financial literacy, because Just
Right.
having the discipline isn't enough. Now you have to put the knowledge to work. And I think the third ingredient is some people, I think, for FIRE or FIWOOT are more entrepreneurial. So that may be more about starting a business. It's taking the hobby that they've got in the garage to more commercial, right? They build the Adirondack chairs for the cottage, who knows?
Right.
So I think some people for financial independence or FIWOOT are kind of wired a little bit to be a little bit of an entrepreneur. And that doesn't mean you have to be an entrepreneur to achieve financial independence. But I think those are the types of people that probably get really amped up and really excited about, the next thing in their life, because they're wired to create, they're wired to develop, they're wired to try and experiment and do different things. So motivation, definitely literacy, and then obviously having a bit of an entrepreneurial spirit. I think those are the people that are probably FIWOOT like.
Great. I'm being curious here. So throughout these years of saving and investing and trying to reach FIWOOT, was your wife on board with you all the time? Like, was it a couple goal, or did she join your venture at some point?
So in the early days, it was like Mark spending a lot of time on a blog and, hey, remember we have dinner plans tonight, so get off the laptop. But like, all joking aside, like, my wife is a huge supporter of my own advisor journey and our story. I know I write about, my investments, our investments a lot, but behind the scenes, she's quite aware about what we're investing in and why, and some of the reasoning involved. So that's been awesome. And then obviously with the cash flows and portfolios venture, she's very supportive of that as well. And why I have a passion to kind of help other DIY investors, right, with their retirement income reports and planning and such. So that's been cool. Obviously, she does not take as much deeper interest into all these subjects as I do, because I'm the one writing. But, she's been a great supporter, and she does the proofreading now and again on my site to make sure I don't have a gazillion typos everywhere.
Oh, really?
Yeah. So she's been really helpful for all those things. And she's definitely on the FIWOOT scale back semi-retirement plan with me. So we're moving in lockstep, which is really cool.
Like I've said, you told me before we record that you were about to semi-retire or reach FIWOOT, like you said. So do you have any special projects in mind for 2025?
I have a few ideas. I don't know. It's going to take a little bit more time. So that's why I want the life-work balance a little bit. I think I'm just looking to having a couple extra days, maybe a week, where I do the things like I mentioned. Maybe it's play a little bit more golf. Maybe I hop on the mountain bike and I go for a longer ride one day. Maybe it's like little short-term trips around the Ottawa area. Maybe, hit up the Nordique spa a little bit more, or go to Montebello for some nice cheeses and things like that. So I think just trying to do little more day trips and little more fun things. Not that we don't do some of those things today, but you have a little bit more of the flexibility to do it, right? So I think those are my big kind of goals, is just to use next year and maybe even part of 2026, almost like a transition period, right? And then we'll see what comes after that. So yeah, that's the thing.
And I think it's great that you share that with your wife, because that's another thing that we didn't necessarily mention, but I think it's important, because some people are financially independent or retire early. They're alone because everybody else around them is working. So the fact that you can share that extra time with your wife and have a buddy by your side, it makes the goal even more interesting, I believe.
Yeah, thank you. I appreciate that. Hopefully our plans are all going to sync up together, and the stars are starting to align. So that's kind of fun.
All right. So before I let you go, Mark, listeners can find more information about you on myownadvisor.ca. You also offer a low-cost financial projections service called Cash Flows and Portfolio. Please tell us more about that.
Yeah. So again, with my partner, Joe, basically what we do is DIY retirement income reports, by DIY investors. So like ourselves. And we basically just offer up our time and services with some professional solutions that we've had access to. So commercial solutions that work in the financial planning community. By doing it at a low cost, we're basically doing it quite a bit less than certainly a lot of other folks are doing it, for sure. And we're doing that purposely just because we'd expect that from a DIY community. And we're also certainly not providing advice. We're not providing recommendations. We take your inputs, we take your information, we do some work in the software solution. We run some analyses based on your goals. Maybe you want to retire early. Maybe you want to sell the condo or house. Maybe you want to get CPP sooner than later. And so we work with you with all those assumptions and parameters. and we provide you with some really value-added reports to use as your own decision-making, your own guidance. So we help you with the interpretations, we help you with some of the analysis that's in your reports, but we feel we can do it in a very low-cost way because we're not providing any financial advice and we're not making any direct recommendations. So far so great. We've helped hundreds of people, and it's really fun to help that many people.
So listeners, if you want to have more information about that, cashflowandportfolios.com, but I will also put the links in the show notes at thedividendguyblog.com/213. Well, thank you so much for your generosity, Mark. It was such a pleasure to have you.
Yes, it's a pleasure. And, we've touched base over emails and X and Twitter over the years. And I've seen you with Mike on the podcast and stuff. So it's always nice to contribute. And definitely we have a shared passion for all this stuff. So happy to come back again and we can talk about a whole range of other things whenever you're ready.
Of course, you're always welcome. Thank you so much. Listeners, this episode was a good inspiration to pay yourself first and choose a lifestyle that you want. For the show notes and the links to Mark's sites, visit thedividendguyblog.com/213. If you enjoyed this podcast, hit pause and click the subscribe button underneath our logo to avoid missing any episodes. If you'd like to appear on the show, message me on the Dividend Guy blog Facebook page or at the Dividend Guy on X. And until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.